Silver occupies a unique position in global commodity markets, straddling the line between industrial necessity and monetary refuge. This dual character creates persistent pricing anomalies and volatile demand patterns that distinguish it from both pure industrial metals like copper and traditional store-of-value assets like gold. Recent market behaviors suggest this identity crisis is intensifying, with profound implications for price discovery and portfolio allocation strategies. Silver's exceptional electrical and thermal conductivity properties make it indispensable across expanding technology sectors. Solar photovoltaic installations alone consumed approximately 140 million ounces in 2023, representing nearly 15% of total annual silver supply. This figure understates the metal's strategic importance, as each gigawatt of solar capacity requires roughly 20 tons of silver, creating a direct correlation between renewable energy targets and silver consumption. Electric vehicle manufacturing presents another demand vector gaining momentum. While individual EVs contain relatively modest silver content, typically 25-50 grams per vehicle, the exponential growth trajectory in EV production translates to material silver demand. Industry projections suggest automotive silver consumption could double by 2030, adding pressure to an already constrained supply base. The proliferation of 5G infrastructure and edge computing facilities further amplifies industrial silver requirements. High-frequency applications demand silver's superior conductivity characteristics, making substitution economically unviable despite the metal's premium pricing relative to alternatives like copper or aluminum. Simultaneously, silver maintains significant monetary metal characteristics that trigger safe haven buying during periods of financial stress or currency debasement concerns. Central bank monetary expansion cycles consistently correlate with increased precious metals allocation, with silver often experiencing amplified volatility relative to gold due to its smaller market capitalization and higher beta characteristics. The silver to gold ratio, currently hovering near 85.1, remains elevated by historical standards, suggesting either silver undervaluation or gold overvaluation relative to long-term averages around a 60-70. 1. This ratio's persistence above historical norms reflects the market's ongoing uncertainty about silver's primary identity: industrial commodity, subject to business cycle dynamics, or monetary alternative responsive to monetary policy cycles. Federal Reserve policy decisions create asymmetric impacts on silver pricing through multiple transmission mechanisms. Rising interest rates typically pressure precious metals by increasing the opportunity cost of holding non-yielding assets. However, silver's industrial demand component can benefit from economic growth conditions that often accompany initial rate hiking cycles, creating cross-currents that complicate price direction. Conversely, accommodative monetary policy environments tend to boost silver prices through both safe haven demand and industrial activity support. The metal's sensitivity to real interest rates, nominal rates adjusted for inflation expectations, often exceeds gold's responsiveness, generating higher volatility during monetary policy transition periods. Silver supply dynamics compound the demand-side complexity. Approximately 70% of silver production occurs as a byproduct of base metal mining operations, creating supply inelasticity that responds poorly to price signals. When copper, lead, or zinc production declines due to economic conditions or operational challenges, silver output contracts, regardless of silver-specific demand fundamentals. Primary silver mining operations face escalating production costs due to declining ore grades and increasingly stringent environmental regulations. Mexican and Peruvian mines, collectively responsible for nearly 40% of global production, report average ore grade declines of 2 to 3% annually, necessitating higher silver prices to maintain profitability and exploration investment. The dual identity dynamic creates persistent arbitrage opportunities between paper and physical silver markets. Exchange-traded funds holding physical silver have accumulated substantial inventories, yet periodic delivery squeezes in futures markets suggest underlying supply tightness that paper markets inadequately reflect. COMEX warehouse stocks have declined substantially over recent quarters, while industrial demand remains robust, indicating structural shifts in market dynamics. The concentration of silver ETF holdings among relatively few custodians creates additional complexity, as large redemptions could trigger significant price volatility during stress periods. Geographic silver market dynamics reveal additional complexity in the metal's dual identity struggle. Asian markets, particularly China and India, demonstrate pronounced industrial silver consumption growth rates exceeding 8% annually. Chinese electronics manufacturing and solar panel production drive substantial silver imports, creating persistent trade flow imbalances that influence global pricing mechanisms. India's traditional cultural affinity for silver jewelry and religious artifacts adds a third demand component, decorative consumption, that operates independently from both industrial and monetary demand cycles. This cultural demand component provides relative price stability during industrial downturns, but constrains supply availability for technological applications during economic expansion periods. North American and European markets exhibit stronger correlations with monetary policy cycles, reflecting regional differences in silver perception and utilization patterns. European renewable energy mandates create predictable industrial demand, while North American precious metals markets remain more sensitive to Federal Reserve policy signals and currency devaluation concerns. These regional variations complicate global price discovery mechanisms and create opportunities for sophisticated arbitrage strategies across different silver market segments and geographic regions. Silver's industrial demand faces ongoing substitution pressures from alternative materials and technological innovations. Copper nanowires and graphene applications pose potential long-term threats to silver's dominance in certain electronic applications, though implementation challenges and cost considerations currently favor continued silver utilization. Solar panel manufacturers actively research silver content reduction techniques to manage input costs, with some newer technologies reducing silver loading by 15-20% per panel. However, efficiency improvements and expanded installation volumes largely offset these per-unit reductions, maintaining aggregate silver demand growth trajectories. The emergence of printed electronics and flexible display technologies creates new silver consumption categories that offset potential losses from traditional applications. Internet of Things device proliferation generates additional microconsumption patterns that collectively represent substantial cumulative demand. These technological crosscurrents illustrate silver's adaptability across evolving industrial applications while highlighting the metal's vulnerability to technological displacement in specific use cases. Unlike gold, silver receives minimal central bank attention for reserve asset purposes, creating an asymmetric monetary demand profile. However, some emerging market central banks have begun modest silver accumulation programs, recognizing the metal's dual-use characteristics and relative value compared to gold. Sovereign wealth funds increasingly view silver as a strategic resource given its industrial applications and energy transition technologies. This perspective shifts silver from a purely financial asset toward a commodity with strategic national security implications, potentially altering long-term demand patterns. The absence of significant central bank silver reserves eliminates a major potential supply overhang that periodically affects gold markets. This structural difference may support silver price volatility and responsiveness to private sector demand fluctuations. Government-sponsored renewable energy programs indirectly represent sovereign silver demand, as energy independence objectives drive solar installation mandates that consume substantial silver quantities. These policy-driven demand sources operate with different price sensitivities than commercial industrial demand, creating additional market complexity. Silver's performance increasingly correlates with technology sector equity indices, reflecting its growing industrial identity. Semiconductor and renewable energy stock movements often presage silver price directions, suggesting fundamental shifts in the metal's financial market relationships. Currency market dynamics continue influencing silver valuations through traditional precious metals channels, though these correlations appear weakening as industrial demand components gain prominence. Dollar strength episodes generate less pronounced silver weakness compared to historical patterns, indicating reduced monetary sensitivity. Bond market developments affect silver through multiple pathways. Real interest rate changes impact precious metals. Demand, while yield curve movements influence industrial activity expectations. This dual sensitivity creates complex hedging requirements for silver market participants. Commodity index inclusion and ETF proliferation have financialized silver markets, introducing additional volatility sources unrelated to fundamental supply-demand dynamics. Algorithm-driven trading strategies often ignore silver's dual identity, creating temporary price dislocations that fundamental analysts can potentially exploit. Multiple scenario paths could resolve silver's identity conflict over the next decade. An acceleration in renewable energy adoption combined with breakthrough energy storage technologies could decisively establish silver as a strategic industrial metal, potentially doubling current consumption levels. Alternatively, monetary system instability or persistent inflation concerns could reactivate silver's monetary characteristics, driving safe haven demand that overwhelms industrial consumption patterns. This scenario would likely reestablish traditional precious metals, correlations, and volatility patterns. A third possibility involves continued dual identity persistence, with silver markets segmenting into distinct industrial and monetary components operating with minimal cross-influence. This outcome would require sophisticated market participants to analyze and trade each segment separately. Economic recession scenarios present particular complexity for silver analysis, as industrial demand destruction conflicts with potential safe haven buying interest. Historical precedents provide limited guidance given the evolution of silver's industrial importance since previous recession cycles. Silver's identity conflict appears likely to intensify rather than resolve as technological advancement accelerates and monetary policy remains experimental globally. The metal's growing industrial indispensability conflicts with its traditional role as a monetary hedge, creating valuation challenges for both fundamental and technical analysis approaches. Investment strategies must account for this duality by considering both macroeconomic monetary policy cycles and microeconomic industrial demand trends. Silver's higher volatility relative to gold may appeal to tactical traders, while its industrial demand floor could provide downside protection during economic growth periods. The renewable energy transition represents perhaps the most significant structural demand driver, potentially overwhelming traditional precious metals supply-demand relationships. Should solar and electric vehicle adoption accelerate beyond current projections, silver's industrial identity may definitively eclipse its monetary characteristics, fundamentally altering its correlation patterns with other precious metals and broader financial markets. This evolution would mark a historical inflection point for a metal that has served dual purposes for millennia, transforming it from a hybrid asset into a primarily industrial commodity with monetary characteristics relegated to secondary importance. Understanding and anticipating this potential transformation remains crucial for commodity market participants and portfolio managers seeking to navigate silver's increasingly complex market dynamics effectively.